Eran, go ahead.
So, Oded, I actually have got a stopwatch. I'll put it on 8 minutes. So I'll start perhaps by saying 8 words. Oil prices have fallen dramatically, but they're not far, actually, from the average that they've been in the 2000s. So that's the brief review. The longer review, for which I have, if this will work, 8 minutes, is let me give you a bit about the price of oil in perspective, then talk about what economic fundamentals drove these oil prices, what political factors. If I have a minute, I'll talk about effects on the Israeli and US economies, and then about forecasts. So just to put in perspective, these are annual Brent prices since 1976. In nominal terms, we see them relatively low till the 2000s, relatively by our standards now, and then they shot up and became more volatile. You can see it more clearly in this picture, which is monthly since '86. The vertical line that you see there are the September, this for some reason doesn't work. The vertical line is the September 11th attacks, and that, since then, oil prices have been on an upward trend with much higher volatility. They've gyrated up and down. And also we see at the end this disparity between the price of Brent and WTI. But by the way, you can see here both nominal and real prices, and they're not that different. So the big issue is not inflation. The big issue are oil prices. Sorry? The WTI is the red line, the blue line is the Brent price. For those that don't know, the Brent is a European price based on North Sea. The WTI is an American measure, Western Texas, right? Intermediate. And it's the US benchmark, if you like. And recently there was a spread of about $5 between them, with Brent being the high one. So here you can see it very clearly. The last year, and you can see the big drop from the summer, from the triple-digit levels, about $107 in July to 60. It's written here 61, but just before coming here, I saw that it's already $63 a barrel. Prices were last seen at this level in 2009. Now, actually, this is not very far from the average of the past 2 years, and it's not very far from the average of the 2000s. So we've been roughly at $70 in the 2000s, and we are now just a bit below it, but volatility is huge. What brought these price declines? Well, a few key factors, with the main ones being the supply factors. There was a big acceleration in oil prices due to US production and due to non-OPEC production, such as Brazil and the Gulf of Mexico. The US production is a key element. There was also an increase in OPEC production because some disruptions, such as from Libya or Nigeria, died down and oil flowed again. So you've got an increase on the OPEC side. There was no offset, as we've seen at the end of November, from OPEC, unlike in the past. This, coupled with slow demand growth, the world economy is still recovering slowly from the big crisis. It's growing less than expected, more like 3% rather than 4% a year. So demand has been slowing, including from China. So the big news from last week was that the International Energy Agency cut its demand forecast, and that sparked another decline in prices. And importantly, there's loss of pricing power by OPEC, especially by Saudi Arabia. For example, Saudi Arabia is now more interested in market share in the Asian Pacific region than in cutting production and raising prices. So there are clear economic reasons. There are a number of at least rumors or ideas or speculation about political factors. For example, the economist Nouriel Roubini, the one who supposedly forecasted the big crisis, speaks of rumors of a US-Saudi deal of low oil prices in return for US supporting the removal of Assad. And likewise, Thomas Friedman in the New York Times noted that while there's turmoil in Libya, Iraq, Nigeria, and Syria, which are oil producers, and in the past this would have led to price increases, now we've got price declines, perhaps as a result of a US-Saudi deal. What's the effect on Israel and on the US? Very, very briefly. Israel produces gas. This was a discussion up till now today. Prices of gas haven't fallen that much, but gas is increasingly seen as a substitute for oil, so there is a connection between the prices. In Israel, there is indexing of gas contracts to Brent prices, at least for some of the fields, and that means that producers of gas would suffer. And in fact, this is the stock prices of Israeli energy firms. The CEO of one of them is sitting right here. They've all dropped between 20 and 30% on the Israeli stock exchange, on the Tel Aviv stock exchange since October. That's at least correct for this morning. There is another effect on inflation. Curiously enough, inflation is now low in Israel, and there is a risk of deflation, a bit like the euro area. So the problem, falling oil prices is actually a problem because it increases the probability of a deflation. And the black line, this is a Goldman Sachs graph, the black line on the left is declining oil prices. The one saver for the situation, if you like, is the depreciation of the shekel, which is the light blue line on the left graph. So that's countering the oil price decline. So strangely enough, oil prices declines are not such great news, not for the firms producing energy and not for inflation in Israel. It's obviously good for the entire economy. For example, if we look at the US, two Fed economists, Elting and Higgins, estimated an increase of 0.3 percentage points in GDP due to the beneficial effects of oil. So you can expect things similar to that also on Israeli GDP for the usual reasons. On the other hand, in the US, there's also negative effect on the investment in the mining and oil sectors. So again, it's the producers of oil who are obviously hurt. Forecast. The famous US economist, Nobel Prize winner Paul Samuelson said, if you have to forecast, forecast often. And I think for the case of oil, it's doubly true. Oil is extremely volatile, extremely speculative. It's not easy to forecast. But in the 15 seconds I have left, according to my iPhone, you can see two views. There are a number of forecasters, Citibank, Goldman Sachs, Bank of America, Merrill Lynch, which speak of a range of $80 to $90 a Brent next year. You'll give me one more minute and I'll finish. A Bloomberg survey likewise. Merrill Lynch even says going to $50 a barrel. So the consensus is much lower than the summer, much lower of the past few years. But there are risks to these forecasts. Perhaps OPEC will decrease production. There is uncertainty coming also from the financial markets, from geopolitical conditions, from a liquidity premium that's out there. And therefore you see others, like UBS economists, forecasting $100 next year. And you see the IMF, this is a graph from the IMF, giving the most probability. Look on the left graph, the center of the probability distribution for next year is around 100, not 80 to 90. In fact, they give little probability to 80 to 90. So there are two views of main forecasters. Lessons, this would be my last graph. Lessons from the past. We had price declines in the recent past. This is 2006 to 12. You see that the price climbed up to 130-something in 07, 08, and then it crashed from 133 in July 08 to 40 in December that year. Within 6 months, it collapsed from 133 to 40, and then it rose again. For 2 years, it climbed up to the 60, 70 range, and then it went up again to 130. So the usual thing for economists, on the one hand, we may be seeing a price declines also because of cost decrease. On the other hand, we may have price increases.